So Tesla recently reported their Q4 numbers, and after the report, this company went on an absolute tear. In fact, Tesla had their best week since May of 2013. For a company that is valued over $500 billion, that is insane to think about. And as someone who is an investor in Tesla, I've seen some incredible weeks from the company. But is this jump in share price justified by their earnings report? Well, in this video, I wanted to share some key metrics that I feel many investors missed that I would pay close attention to. But I don't want to waste your time, so let's go ahead and dive right in. Now, before I share the caution flags, I'm not saying that I believe the earnings report was awful. There were some great things that the company reported. However, I know that on YouTube, it is very easy to only focus on the good news and the excitement of a company. And so I want to make sure that both sides are covered. Like all companies that I analyze, I want to approach Tesla from 4 key factors: their financial position, growth, margins, and profitability. So to keep things organized, let's go through each one of these factors and see how they've been affected based on this past earnings report. When you look at Tesla's financial position, on the surface, it looks great because the company increased their cash and cash equivalents by over $1 billion. Now, $22 billion of cash for any company sounds amazing. And if you told me that a company of Tesla's size has $22 billion in cash, I would be pretty confident that they have a solid balance sheet. But if you only look at their cash position, you are missing some key changes to the balance sheet. If we look at the company's current liabilities, they exceed their cash position. So they would not be able to cover their liabilities over the next year with the cash that they have on hand. With that said, the company does have more current assets than they do current liabilities, but it's not great like other companies in the stock market. The other part that's interesting about their balance sheet is the increase of $1 billion to their long-term liabilities. So I mentioned these things because no matter if you are an investor in Tesla or not, it's important to make sure that you are reviewing the entire balance sheet and not just if the company increased their cash position. On top of this, the company announced that they are receiving a senior unsecured revolving credit facility of up to $5 billion from Citi and Deutsche Bank, with the option of an additional $2 billion. Now, this does give them optionality, but if they had plenty of cash to do what they wanted to do, then they wouldn't really need this revolving credit. But Tesla's reason for receiving this credit facility is because they want to continue to invest in battery, growth, and storage. So on one hand, you could see this as a good thing over the long term because the company will be able to deploy more money into investing for the future. But on the other hand, Tesla's continued investments and expansion will affect a key factor, and that is free cash flow. But I'll talk more about that later. Now, before I move on to the next factor, I want to say that I don't believe that the balance sheet is awful. In fact, the company still has a good total asset to liability ratio over 2. But I also want to make sure it is noted that there are parts of the balance sheet that I believe investors should pay attention to over the next few quarters, especially when we see expansions and opening of new locations, plus the investments that go into the new batteries and vehicles with the Cybertruck and the possibility for a $25,000 vehicle. And this leads to the next factor, and that is growth. Now, this part of the company in my mind was not only the best part of the earnings report, but the most exciting aspect when we talk about guidance. So the company did beat analyst estimates, reporting revenue of $24.32 billion compared to $24.16 billion. This was a 37% increase year over year. But the question that I would ask is, where did this revenue come from? If you have never looked deep into this company, you would probably assume that this came from their vehicle sales. And that's why it's not a good idea to compare a company like Tesla to other vehicle manufacturers. Year over year, the company reported 33% revenue growth on their automotive revenue. Their largest revenue growth actually came from their energy generation and storage, as they almost doubled their revenue in this segment. And we also saw 60% growth in their services and other segments. When we look at the company's growth moving forward, there is no question that in the short term, we have seen an increase in demand due to Tesla's price cuts. And Elon announced that for 2023, the company is projecting to produce 1.8 million units with the capacity to produce 2 million units. As a Tesla bull, this should make you excited. Now, when I look at this year, I think a lot of this is going to be dependent upon how bad the recession gets, especially when we talk about unemployment. What we saw before the price cuts is that demand was slowing, and with many companies cutting higher paying jobs, demand could have slowed even more. But these price cuts have played a substantial role in demand for Tesla, and so we will see if this demand will continue. Now, it's important to note that we are not going to see major revenue from the Cybertruck until 2024. Production will start briefly in the summer of 2023, but the ramp is going to be visible in 2024. And this is by far the most debated vehicle I have ever seen. And let me know in the comments down below whether you like the looks of the Cybertruck or not. What I will say about this is that if we are seeing massive ramp in Cybertrucks in 2024, we probably won't see revenue come from their $25,000 vehicle until at least 2025. Now, I hope I'm wrong about this, and this is total speculation, but I think this is something to consider when you make revenue projections for Tesla. But with all that said, I want to talk briefly about Tesla's autopilot, because over the past few months, we have seen companies share news about their autopilot systems. Honestly, they are still nowhere near where Tesla is at right now, which could mean that until other auto companies get this figured out, Tesla will continue to grow and take market share. And so I would encourage you to look at what is actually going on with these other companies who say they have autopilot. Overall, Tesla's growth remains strong, and so we will see if this continues throughout the year. This is key for Tesla because this acceleration in demand comes after Tesla had massive price cuts, and the biggest question that investors have is what is this going to do to the third key factor, which is margins. Now, the company has said that cost reductions is a priority for them to be able to offset the price drops. However, we need to recognize what actually happened over the past year and what this could mean for the company going into 2023. If we look at Tesla's automotive sales again, they grew 33% year over year. However, when we look at the cost of revenue for automotive, how much do you think that this segment increased? 44%. And think about it this way, that was without the substantial price cuts that we saw in the US. Now, we did see price cuts in Asia, but when the cost of revenue outpaces revenue growth by over 10%, I think this is a caution flag to pay attention to over the rest of the year. On top of this, the company missed on automotive gross margins by 0.6%, and many investors agree that Q1 is going to be worse than Q4 of last year because we will now start to see the effects of the price cuts. Now, I do believe that over time, Tesla will be able to figure out their inefficiencies with their Austin and Berlin gigafactories. But this isn't something that can be fixed overnight. Cost reductions take time, so we could see lower margins for the majority of this year, if not all of this year. Another thing is that even though the company isn't fully exposed to lithium for their batteries, we are still seeing this as a headwind in 2023, as they are expecting lithium to be higher this year than last year. So there are some pressures for Tesla's margins that have to be considered. The other thing is that Tesla constantly talks about making their vehicles more affordable, and if there are plans to cut prices again because they have more leverage than their competitors, this could once again put downward pressure on margins. Now, I do believe the company will figure out a good amount of cost efficiencies, but it will take a while to get back to what we saw in the past. So lastly, we have profitability. And in a recessionary environment, this is extremely important to investors. There are a couple of metrics to look at when measuring profitability, and they are net income and free cash flow. Personally, if I'm simply trying to figure out a company's future projections, then I like using net income. But if I want a deeper analysis or I'm already invested in the company, free cash flow, in my opinion, is more important. Now, Tesla has a low free cash flow yield of over 1.5%, which is not great. And the worst part is that we have seen their free cash flow shrink. Companies use their free cash flow to either reward shareholders or invest more into growth. And so if you have reduced cash flow, that means in Tesla's case, they need more cash to invest into their growth, which is why I believe they needed the credit facility that I mentioned earlier. With that said, the company has reduced their SG&A, or selling, general, and administrative expenses, which is nice to see. Now, a big reason for the reduction in free cash flow is because their cash from operating activities has declined about a third over the past year. This is not good either, because if you want to find free cash flow, you take the cash from operations, also known as the operating cash flow, and subtract the CapEx, or the investments in property, plant, and equipment. And so if we saw a decline in cash from operations, plus the company is planning to add more and more investments through expanding facilities and building new ones, what is this going to do to their free cash flow? It means more downward pressure. And this is a major reason why I don't like using the Ford PE metric for Tesla. This metric has been used by many investors to prove that Tesla is undervalued. But if we look at Tesla from a free cash flow perspective, we can actually see that there is an argument for the company to be at fair value. There is no question that Tesla has tremendous potential for growth when it comes to all the vehicles that they are producing, their energy business, the robotics segment, and the robo-taxi network. But as we have seen with their current cash position, the added credit facility in order to continue growth, plus the shrinking in free cash flow, this gives me cause for concern in terms of valuation for the short term. And when I say short term, I mean over the next couple of years. Now, I know that Tesla is always priced years in advance, so we can easily see the stock price completely ignore these pressures and skyrocket anyways. But I do believe these are things to consider. Lastly, when we look at all the different growth potentials for Tesla, we need to consider the amount of money that has to be invested into these segments. This is why I believe that even though we could see growth and cost efficiencies rise over the next couple of years, free cash flow may not grow as much due to the investments in new facilities, new products, and new growth opportunities. This is why for me, rather than investing directly into EVs and Tesla, I'm investing into a semiconductor company who is focused on the EV sector and autopilot, and also has partners like Tesla, Hyundai, and Kia. So if you haven't seen this video, click right here. Hope you all enjoyed this video, and I'll see you in the next one.